We see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time. And we have to deal with that uncertainty around data. The policy is restrictive and is having the effects that we would hope for. We think we're getting the things that we would want to get, broadly speaking. Rate cuts that might have taken place this year, take place next year. We'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks. Really, the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions.
Coming up today, inflation comes in better than expected. A look at all the data, what the Fed is going to do next, what it means for stocks, Apple ripping again, an update on GameStop, Russian warships near America, and one of the best performing stocks you've never heard of. And just like clockwork, we played out that seasonality from yesterday that I showed you pretty much every time we get a Fed and CPI day together. It's very bullish for the market. Played out almost to the T, with tech stocks moving up really good, the Nasdaq, S&P 500 breaking out to new all-time highs again. And while we've got a little mixed stock sector breadth, we've got some downtrends in all the right places. Volatility and bond yields, and also now inflation expectation underneath the 50-day moving average. Leading the show again today, mega cap tech. Magnificent 7, moving up higher on the composite chart there. The Russell 2000 reclaiming its 50-day, although it was sold off into the close. And we have been getting some softening breadth lately. However, a little bit of an improvement today. There's volume breadth on the Nasdaq, breaking out to multi-week highs. Still got more than half of all S&P 500 stocks below the 50-day moving average. And even though new highs outpaced new lows today, still not really breaking out here. Although a bit better on the Nasdaq. So it's really tech and semis coming back to this party. Big crash on the VIX, barely holding onto a 12 handle. Volatility risk premium falling off. The skew index falling down, which is bullish. Bond yields losing support. I'm going to get a bit more into that later on. Really nice move up in high yield bonds. Dollar pulling back down. Bitcoin bumping up a little bit there. Oil just consolidating around the 50-day VWAP. And look at that monster move and Apple on massive volume. There's some wholesale big money coming in here. Almost 200 million shares traded on a $200 stock. Briefly making it the largest company in the world again today, overtaking Microsoft before Microsoft came back for close to reclaim the #1 spot. Get a bit more into that later on. However, just to give you a quick summary on my thoughts here, very bullish, as it always has to be anytime the market's breaking out to all-time highs. Not exactly a bearish signal, and markets don't really crash after making all-time highs. Typically crash when they're already weak underneath their moving averages. And let's keep in mind, we've pretty much got every sector above the long-term 200-day moving average. So the bull market is still well and truly intact and appears to be strengthening, really low volatility. And based on that weaker CPI print today, could be truly going into that Goldilocks scenario of a soft landing, where economic growth and the jobs market just softens a little bit to bring inflation back, allowing the Fed to cut rates without anything too big blowing up, causing a sharp spike in unemployment and a recession. Still yet to be definitely seen. However, it appears we could be on that path, and the market's certainly trading as if we're on that path like it has been for a few months now. But stick with me because I'll come back to the charts and show you everything else I'm seeing out there. First, let me just run you over all the data to give you a clear picture of what's happening and what to make of it all. So the big ones today, inflation rate, month over month, expected to grow 0.1%, actually came in flat. Year over year, headline 3.4, came in 3.3, so marginally better. And it's funny, isn't it? Because the market's getting real excited with the print of 3.3 in inflation. And it's almost like we're already in the world where 3% is the new 2%, and the market doesn't even seem to really care whether we get that 2%. Or maybe it thinks we could be seeing a 2% handle in the coming months, which would be a huge drop in the CPI. And there's a look at the 12-month price change of key categories that make up inflation. Auto insurance still leading the way, along with rent, housing, energy, earnings, restaurant meals, medical care and transport. Down the bottom, used vehicles, rental cars, toys, airfare, appliances and furniture, leading the way with disinflation. And like I'd been saying, that falling price in oil these last couple of months pulled back gas, and that strongly correlates with inflation. So that's helped a lot. In addition to that, we've got core services excluding shelter actually showing negative month over month inflation, which is a good sign for consumers there. And there's motor vehicle insurance, which could be rolling over as well from its high peak. Last print 20.3% year over year. Gain an average auto insurance policy. Just stepping back and looking at the overall CPI long-term trend over the last 35 years. Headline in the purple, core in the green. Still well and truly above the long-term average where we've been over the last 30 years. And just showing that the path from 9% to 2% isn't a straight line. It's going to be a bit bumpy and a bit messy if we can even get back down to that 2% or lower average anytime soon. And just looking at the categories of what's really driving inflation year over year, it's mostly shelter here in the dark green. Food and energy is not that bad, and it's actually used in new vehicles and consumer demand impacted goods that are actually disinflating. But that average is still a little bit too high. And just looking at the Fed's official PR, they said recent indicators suggest economic activity has continued to expand at a solid pace. Job gains have remained strong and the unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. In recent months, there has been modest further progress towards the committee's 2% inflation objective. And they're still calling for inflation at 2% over the long run, basically just sounding the same way as they have been when they actually had a chance to get a bit more dovish today on that CPI print. So they kind of came in a little bit more hawkish to offset that low CPI print, which was a little bit interesting. And just going over a summary of key points from Jay Powell today, basically said it's too soon to tell if Fed policy is sufficiently restrictive. Pretty much said none of his members were thinking about hiking rates though. Also, funny enough, said Powell has no definitive answer on why Americans view the economy so negatively. Maybe it's something to do with the average price of things have gone up 30% in the last couple of years. He still thinks policy is restrictive, won't eliminate the possibility of hikes, but no one's really thinking about it. Also interesting, says recent jobs data may be a bit overstated. Sure, whether he's implying the government's been cooking the books a little bit, or maybe he's referring to some underlying weakness in the jobs market, maybe with the growth of part-time jobs and the fall off in full-time jobs. Said he doesn't have the confidence to lower rates just yet, and they need more good data on inflation, which I think they're just looking for a couple of more good prints, get that CPI down to a 2 handle. 2.9 I think will give him the green light to go ahead and follow some of his global peers and chop rates. Said inflation's eased substantially, but it's still too high. Said the economy's made progress towards both Fed goals. They've kept their quantitative tightening at the same level, running off about $60 billion worth of assets from their balance sheet every month. But interestingly, like I said, they came out a little hawkish and said taming inflation will take a little bit longer. And they actually dialed back their projections for cuts to just 1 this year, and actually increased where they think rates will be next year and in 2026, along with their longer term target. Here's the Fed's dot plot, in which Fed members anonymously enter in their projections for where they think Fed funds rate is going to go out in the future, and then we get to look at the average of that. So their latest dot plot for this year, they're still projecting rates be around 5%. Next year, around 4.2. 2026, about 3.1. And in the long run, about 2.75. And you compare that with their dot plot from March. They were actually calling for rates this year of 4.6. Next year, 3.8. Into 2026, 3.2, and longer term, just above 2.5. So they've actually lifted up their dot plot here today, even though we got that softer, better than expected CPI print. So it was a bit interesting. Maybe something's making them think rates are going to be a bit higher. Maybe the blowout in US debt, maybe commodity prices, shipping. So it was a bit of a counterpoint to the soft inflation print we got today. However, as always, just following the tape, bond market rallied and yields pulled back as it paid more attention to that CPI data instead of a somewhat hawkish Jay Powell given the setup. There's a 2-year actually spiked down to 466 today, and the 10-year notably lower as well, and could be in a bit of a topping pattern here. If not consolidation, you could almost call it a head and shoulders. They would have to take out some support below 420, then again at 405. Then the next thing, we could be in a bit of a downtrend in bond yields. Got the interest rate sensitive TLT having a good day as well. Investment grade bonds breaking out along with high yield bonds, multi-month highs. So it's true, on a number of measures, we do have some good signs of disinflation. Auto insurance, and with services too, being the biggest driver of inflation these last couple of years. And so far, food and energy are staying tame as well. However, most Americans are still labeling inflation as one of their top concerns, things that are affecting their day-to-day lives because of that embedded structural inflation. And new research shows that most people actually blame the government for that, which is factually correct. If you study history, you'll know pretty much all inflation caused by the government, because for there to be inflation, there has to be more money. And for there to be more money, the government has to print it or give it away or spend too much, which they've done all of the above. And if you also study history and how the Roman Empire fell, you'll also discover that printing money was part of it, along with corruption at the top and sending political opponents to prison, along with too much debt, so on and so forth. Pretty much the same things cause all empires to peak out. But even though most Americans are still struggling, same deal with consumers around all Western democracies. Wall Street's parting like it's 1999, and they see a clear path to a soft landing as this Goldilocks scenario looks to lengthen further. In fact, this bull market that started in October 2022 has been one of the most resilient ever against one of the most aggressive rate hiking cycles ever as well. Fed started hiking rates in March 2022, jacked them up over 5% into July last year. And ever since the Fed started hiking rates, S&P 500 is still more than 25% higher back in March 2022. And even though typically the stock market can fall over when the Fed starts cutting rates, that's if it's already got some weakness and in a downtrend like we saw in 2008. And in response to an emergency in the economy, things really fallen off a cliff. However, what happens when the Fed's cut rates with stocks at all-time highs? Well, just looking at the S&P 500 performance, after the Fed cuts within 2% of all-time highs, 12 months later, the stock market is higher every single time with an average return of 13.9%. So the algos know this, big funds know this, and that's why this market is really long and can still have a bit further to go. But not all is good underneath the hood, even though we do have a really low VIX here, and that can persist for some time. Markets grinding higher, low volume days, low volatility at the index level. However, underneath the hood, still got some big swings in individual stocks, and we're now approaching 350 trading days as the markets move 2% up or down. And just looking at the S&P 500 one-day change averaged over the last 3 months, currently at 0.53%. That's how much the market on average is moving each day, which is pretty close to the low end of its historic range. And so we can see implied correlation amongst the market. That's how much all stocks are correlated to one another. Pretty low here at 10.9. And just zooming out to a long-term monthly chart, that'll typically spike up in bear markets and crashes as correlations move towards 100, because when there's a big liquidity crunch, pretty much the sell button gets hit on everything as the market deleverages. And the opposite is true at the top of bull markets. There's a lot of dispersion in the market. Index could be doing one thing, and a lot of stocks can be doing something completely different. And we can see in that period when the market really fell apart in 2008, implied correlations stayed pretty high for years there, averaging above 60%. Before it's come off, got pretty low there in 2018, spiked up in 2020, and here we are sitting pretty low now. So basically, that doesn't mean everything's going to fall off a cliff tomorrow. It just means we're most likely approaching a top. However, we can stay in this low volatility grinding environment for many more months to come, and potentially all the way throughout next year as well. And bull markets can last longer than you think. Just in general, market prices can go further and for longer than what we naturally think. Just looking back in history, average bull markets lasted 61 months. Currently, this one's 20 months old, kicked off in October 2022. So if we hit the average, that's another 40 months, which is more than 3 years. That would surprise a lot of people if we didn't topple over until 2027. However, the last bull market was the shortest one we've got, 21 months. It kicked off after COVID before topping out in early 2022. But for now, things are ripping, especially when we got one of the biggest stocks in the world and formerly one of the most important stocks in the market coming back into the spotlight. That's Apple, with the street loving the developers conference and what they're hearing. They've got a real shot at making something out of their new telephones, incorporating AI features, should spur on a big global upgrade cycle. A lot of people out there, myself included, smartphones are about 4 or 5 years old, coming up to the time to upgrade. And until there's a decent alternative, a lot of people like myself will probably end up getting the new iPhone. And that's what briefly today made it the largest company in the world again before just slipping back before close. 3.3 trillion, and we very well could see some 5 trillion market cap for this bull market is finished. However, there's still plenty of concerns out there from people with Apple partnering with OpenAI, pretty much giving them a backdoor to your entire life data. It's all up for sale to the highest bidder, and God knows who else, opening a bit of a Pandora's box and potentially creating a void in the market for someone else to develop a truly encrypted smartphone device with all the latest bells and whistles as well. And like I've been saying, this is still a concentrated, skinny bull market. In fact, NVIDIA's accounted for 34.5% of the S&P 500's return so far this year. So over a third of the gain in the S&P is from one stock. But not only is this the election year, which is very bullish seasonality, we've got a lot of other technical bullish seasonal signs as well. For example, when stocks stay above the December low, good things tend to happen. And that is when the S&P's low in the first quarter of the year, is above the low from December, the final 3 quarters finish up about 92% of the time, with an average gain of 11%, making for a full year positive returns 94.6% of the time. Really tough environment and stats to bet against if you're a bear. And just going deeper underneath the hood, looking at sector seasonality, average monthly performance for all 11 S&P 500 sectors going back to 1990. June can be a little bit of a soft month, especially so for materials and financials. Funny enough, we've already been seen. However, next month is the 3rd most bullish month on record, July, with tech, financials, and real estate historically putting in the best performances. And there's a look at one of the largest, most liquid real estate ETFs, IYR, which has been consolidating all of this year and just going out to a long-term monthly chart, hasn't actually done much over the last decade, and one could still argue that it's still in a bear market. And we'd really need to see a good breach of this downtrend before we could say it's going into a stage 2 advance. However, we could be getting near the end of a stage 1 accumulation, and with average dividend yield around 3%, and inside the fund, it's not too hard to find REITs with dividend yields above 3%. If bond yields are really going to come down, that's supportive for REITs, just increases the margin between the cost of capital and the rent, and valuations should be marked up. So not just for next month alone. However, if rates have topped out, then REITs could be a place to be. And me personally, I like land REITs because it also includes a hedge against inflation, in addition to still benefiting from lower rates. However, I'm not the only one that knows about this. We're all looking at this same seasonality. Quite often, when everyone's standing on the same side of the ship, it can often topple over. And so it's kind of interesting, isn't it? As we go more into the digital age and data age, we can easily dig up stats, see what's worked in the past, and how does that affect things going forward if everyone knows about it. Doesn't mean it can't happen. The crowd's not always wrong. Consensus can still play out as consensus expects. However, we could still be all jinxing it. And like I always say, we won't know until we know. Moving on from the broader market to one of the hottest stocks out there, GameStop. You guys know I've been covering this. Watching Roaring Kitty and his monster position and what he's going to do with his 120,000 call option contracts expiring next Friday. Is he going to exercise them? Was he going to offload them? Well, it looks like late this afternoon, he may have started offloading them. Looking at the $20 call strike, which he owns 120,000 options. Huge volume coming in into the close, 93,000 contracts. It's like potentially he was exiting. And there's a look at the daily on GameStop, finishing down 16.5%, just going down to a 5-minute chart. He started offloading in the last hour and down she went, trading pretty heavy there into the close and finishing a few points below where GameStop themselves were actually able to sell 75 million shares at market for an average price of $28.49. Their last secondary back in May, they achieved $20.74 with a bit of prior price support a bit below that, around $19.20. And some people are saying, Roaring Kitty's bailed, he's paper-handed it or whatever. Let's not forget, he's parlayed 50,000 into over $250 million. More importantly, he's still all in for the long term, and he's helped GameStop add a further $3 billion to their balance sheet, now taking their total liquidity over $4 billion in cash. They've got no debt, just the interest they'll be making on that cash, keeping it in treasury bills. Just basic treasury management will exceed the current losses from the underlying business. Plus, they can do an exciting acquisition, maybe get into Bitcoin, AI, who knows? Definitely got the spotlight and the capital now. And the market cap is still only around $9 billion. So they've got almost half of their market cap in cash on the balance sheet, which is a very strong position. And if they can somehow go cash flow positive over the next couple of quarters or year, well, that's going to be a hard time for the short sellers to try and jump on top of that, because typically these short selling hedge funds gang up on stocks that are losing money and spread fear, uncertainty, and doubt FUD throughout the media with their journalist friends and themselves. They just get really upset if someone like Roaring Kitty does it back to them, calling it market manipulation. Only we're allowed to do it. But anyway, the story goes on. Be interesting to see if Keith Gill's going to reload up into more GameStop shares now that he might potentially have exited most of his call options, because he had to do something with that. But we don't know that's definitely true yet. We'll have to wait till he posts another update on his Reddit account to see what actions he may have taken today. Moving over to commodities. Got oil sitting pretty around the 50-day. A rise in crude and gasoline inventories. The International Energy Agency lowers its forecast for demand growth. And while we've still got good demand for oil and gas there, we've got supplies matching it and exceeding it. And we saw that in the prints we got today with both oil and gas inventories coming in a lot higher than expected. Also interesting, we just heard from the International Energy Agency saying peak oil demand before 2030 will usher in a major supply glut. Now, we've heard about this before, peak oil. It's like it almost comes up every decade. However, the difference this time is we're on the cusp in many countries. In fact, some countries even get more of their energy demand from clean renewable sources now than they do from fossil fuels. So the days of digging hard material out of the ground and then burning it for our energy, I think it's reasonable to say that it should be in a secular decline, even though fossil fuels are still going to be used for many more decades. Oil especially, just things like coal are in a downtrend. And it's interesting because a lot of the Middle East and Russia have financed their economies for decades and decades through selling oil largely to the West. What happens if the West continues its path to self-reliance on energy, clean renewable sources that never run out? Cost of energy will come down. And again, if you look through history, prosperity for countries is often correlated with the cost of their energy. Not only that, we won't be sending our dollars overseas just to get our energy. And just like if you corner an angry dog, sometimes it may bite back. It's got no other option. We've got Russia sending warships and nuclear-capable submarine into Cuba for apparently some peaceful military exercises. For those of you who don't know, Cuba is just south of Florida, about 100 miles. Really not that far away from America's doorstep. Could be a bit of a show of force, and Putin just saying, hey Biden, if you're going to mess with me, I'm going to mess with you, and this doesn't look good going into an election. Maybe Putin would like to see a spike in the price of oil. Upset Joe Biden's chance. Maybe Putin does want to negotiate with Trump to save face on Ukraine, and with that, potentially take back some key territory, or at least prevent Zelensky from further aligning with the West and joining NATO as was originally promised. Maybe Putin's got his military assets there as a deterrent after we just heard Biden gave Ukraine permission to use US weapons directly inside Russian borders. Either way, this is still an ongoing scenario. Ukraine, Russia, Biden administration support of Ukraine. What's going to happen if Trump gets back in? What could this do to commodity markets? It's still a fluid, ongoing situation that still has the potential to spill over. And regardless of geopolitics, commodities still have a good setup on valuation relative to stocks. And just looking at this really cool long-term chart, in fact, over the last 220 years, looking at the US commodity price index, 10-year rolling compounded average growth rate, average yearly gain, 10-year rolling line. You can see that has big swings, highs and lows that go on for decades. And we've just come off multi-decade low, currently right around break even, 10-year rolling GAR. And by some projections, that could swing back to a high over the next 10, 20 years. As just looking at that long-term average does have really nice, consistent cycling up and down below the average. And just moving on from commodities to an interesting little stock that I guess isn't so little anymore, and that's Casey's General Stores. I'm sure a lot of Americans are familiar with it. Midwest chain, 5th largest pizza seller by number of kitchens. Same store sales rose 8.8% in its quarter, growing faster than Domino's. They're a gas station. This is the largest part of their business, but they do really well in the food and services surrounding that. And just after their earnings today, in which they smoked expectations, stocks rose up 16% on huge volume. But just taking you out to a monthly chart, turning it to logarithmic, if you want to see what I call a long-term perennial winner, then this is it right here. Here's a long-term chart of Casey's going back to 1983. Split adjusted, it was below $1 a share. Here we are 40 years later, $381 a share, and just goes to show staying invested in high-quality, simple businesses for the long term, there's no better way to create wealth than that. Still only a $14 billion market cap company. And like I said, it's just one of those simple businesses and stocks. Doesn't need to do anything too exciting, doesn't need to reinvent the wheel. Just a simple business done right will always reward shareholders in the long term. Moving on, that's how the market is pricing interest rates going forward now. Yesterday, they were projecting a cut in November. After CPI today, saying it's about a 62% chance they're going to cut in September now. We could get another cut in December. So kind of going against the grain of the Fed's own dot plot, in which they are pretty much showing just one cut this year, and they actually lifted their projections for interest rates going out the next 2 years. Fear and greed index still in the neutral zone. Corporate insiders not doing a whole lot either. Let's look at China, still a little soft and pulling back here. Clean energy still holding ground. And even though we've got American markets breaking out to new all-time highs today, international markets, not so much. Canada's TSX, UK FTSE, German DAX, China 50, Nikkei 225, and the Aussie 200, all a lot weaker than America. So it's not just internal market breadth in America, it's also global equity breadth, not really gone parabolic here. But look at the fall off in value versus growth spread. Growth stocks ripping up today and quite a big bounce back in high beta versus low volatility, and NASDAQ absolutely screaming higher versus the Russell 2000. Bit of a bounce back in discretionary versus staples. Still got copper versus gold a little soft, and inflation expectations pulling back sharply today as well. Best performing sector today was home builders, loving these lower rates. Worst performing sector, oil and gas, followed by staples. Still waiting for cannabis to make a move here, up or down, consolidating in a tight range. DSI is pretty much flat, not giving us much indication here. There's NVDA creeping up. We get a little pullback in Microsoft and Apple. One of these days, NVIDIA could come out in front. A little bit of a bounce back in Tesla as we go into the shareholder vote tomorrow. That'll be an interesting one. See what happens there. Still got other market darlings like Eli Lilly walking the line, ripping up to new highs again here. Maybe getting a little bit stretched. And chip makers like Arm Holding, British chip maker, ripping back up. Supermicro still a little soft, along with AMD doing a lot better and breaking out again on earnings today. Broadcom also announced they're going to split, and Taiwan Semi walking the line as well. And a good result today from Oracle. Even though they missed on earnings, market loved the report and outlook, up 13%. And some of the financials stabilizing a bit there today, but JP Morgan actually still a bit weak. Okay guys, to wrap it up for you today, again, can't argue with the price action. The tail of the tape is bullish, gapping up, held, volatility's low, a little bit of a bounce back in market internals breadth. Still a lot of weakness in the midterm though in market breadth and global equity breadth. However, inflation coming in soft and those bond yields pulling back, it's not hard to see why the market is trading on a soft landing Goldilocks scenario, and so that could persist for some time yet. But looking at my S&P 500 oscillator, we're starting to get back close to overbought levels where the market can consolidate, although that is a softer signal than when it goes bullish, which it's far more accurate. However, either way you cut it, stock market is in an uptrend. Thanks very much for tuning in and supporting this channel, and I hope to see you again here tomorrow night. Cheers.